Welcome to another mathematics lesson where we will be looking at investments and loans, as I had promised in my last lesson. In our last lesson, we were looking at the previous one, we looked at simple interest. After that, we looked at compound interest, where the period was a year. And in our very last lesson, we looked at how to calculate compound interest when the period is less than a year. So in this lesson, we want to look at investment and loans. When we talk about investments and loans, basically when you borrow money from a financial institution, an interest is charged on you. When you borrow money, an interest is charged. An interest will be charged on you. This money, you might have borrowed it from a financial institution, and this financial institution can be a bank or a credit union. The same applies when you invest money, investment. When you invest money in a bank or a circle, you earn interest. Interest is earned. So we have two cases. When you borrow, this is a loan. When borrowing, we talk of loans, and when we talk about investment, you are basically investing. You are investing. So once more, if you borrow, that is a loan, and an interest will be charged by that financial institution on you. And on the other hand, if you invest in a given institution or anywhere, you earn an interest. We have looked at how to calculate this interest, be it simple interest or compound interest. So we can look at what is the definition of a loan. What is a loan? A loan. Let us define this. This is the money borrowed and then repaid, usually with interest. This is money borrowed and then repaid, usually with interest. Why are we saying usually? It means that in some cases you can borrow money but return the same without paying interest. In such a case, you might borrow money from your parent or your relative or a close friend of yours. The person decides to lend you a given amount of money, and then the condition is, as long as you return my money within this stipulated period of time, maybe 1 month, 2 months, or a year, I will charge no interest. So you return the money without paying any interest. But in many cases, the ideal situation is where when money is borrowed, it has to be repaid back within an agreed period of time, but with interest. That interest can be calculated as simple interest or compound interest. we need also to look at another term, repayments. Repayments. When we are talking about repayments, these are basically amounts that are repaid or that are paid to financial institutions. Amounts paid to financial institutions. Amounts paid to financial institutions at regular intervals to repay a loan. To repay a loan with interest included. So what are we saying? That amount that is paid to a financial institution regularly is what constitutes repayments. That amount, that payment can be made either weekly, monthly, or even after 2 weeks or yearly. But mostly these repayments are made monthly because income earners earn their salary or wages every month. So every time they earn, they need to make a repayment towards a certain loan that they borrowed. We are saying it has to be regular because when we are calculating the entire payments, there is need for us to have uniformity, and it is also good to repay a loan within the stipulated period of time. You might have borrowed a loan and then you agree with a financial institution that this loan will be repaid within a period of 2 years or 1 year. So every month when you earn, you repay a certain amount. That is what constitutes repayment. There is another thing that we need to understand is on interest. Interest. We have agreed that interest comes in 2 ways. In the first way is you can be charged interest after borrowing a loan from a financial institution. You are charged an interest. That is the amount above the principal that you borrowed that will be given back together with the principal borrowed to the financial institution. The second way is where you invest your money, then you earn an interest. Those are the 2 ways. So interests are associated with main loan and savings accounts. With many loans, we have interests, and also in savings account. Savings accounts. How do we earn interest in savings accounts? Interest accrues on the minimum balance that you have in that account. Let us say that you have a minimum balance of around $2,000 in your account. The financial institution or that bank decides to give you some interest on this minimum balance that you have in your account. That means you cannot withdraw below this amount. That is the limit. The moment you reach this, you no longer withdraw. And this amount will earn you some interest at the end of a given period as agreed between you and the financial institution. So that is what we have on investment and loans. I want us now to move on and look at some examples that will help us to understand this concept on investments and loans. We look at examples for us to conceptualize the ideas on the same. The first example is we have donor can afford to pay $220 a month. Donor can afford to pay $220 a month. How much does she pay over? A 1 year. How much will she pay over 1 year? So if we are told this person can afford to pay this amount in a month, it means after extracting all the expenses, this person is comfortable to part with $220 every month. This is just a fraction of the salary. So we want to know how much will this person pay in a full year. Every month, $220. In a year, how much will that be? Remember, a year has 12 months. A year has 12 months. So repayment. This repayment will be equal to number of payments. Number of payments. This number of payments can also be called installments. Can also be called installments multiplied by the amount in each installment. The amount in each payment or the amount in each installment. So the number of installments that we have is 1 year has 12 months. So it means we are going to have 12 installments multiplied by the amount in each payment, which is $220. This will give us $3,960. So if this person can afford to pay this every month, then at the end of the year, this person will have managed to pay $3,960. Let us look at part B. How much will she be able to pay in 18 months? How much will that be in 18 months? In 18 months. We have said the repayments, or we can even call this total repayments, because after 18 months we assume that that will have given back the loan plus the interest that was borrowed. That will be 18. That is the number of repayments or installments that should be made, multiplied by the amount in each repayment. How much will that be? This will give us in the first one we were supposed to get 26,400 in the first one. We were supposed to get 26,400. Make that correction. And in this second one, it is where we are supposed to get 39,60. So in the first one, you can correct that we were supposed to get 26,400 in 1 year. But in 18 months, we are going to have 39,60. Let us confirm that. In 18 months, we are going to have 3,960. Let us look at the next one. How much will be the repayments in 5 years? How much will she be able to pay in 5 years? We are saying repayments will be equal to the number of repayments. In a year, we have 12 repayments. What about in 5 years? This will be 5 times 12, which will give us 60 repayments. Then we multiply by the amount in each repayment. The amount in each repayment. And this will give us how much? This will give us 13,200. This will give us $13,200. That is just an example on how to calculate repayments. Let us look at a second example. Example number 2. Example number 2 is Sarah buys a new bed on an interest-free offer. On an interest-free offer. There is no interest charged. That's what it means. The question continues and says, no interest is charged. No interest is charged if she pays for the bed in 2 years. If she pays for the bed in 2 years. That is, if she is going to make repayments for a period longer than 2 years, then interest will come into play. But if she manages to repay within a period of 2 years, then absolutely there is no interest. Sarah's bed costs $24.90. That is $2,490, and she pays it back in 20 months. She pays it back in 20 months in 20 equal installments. In 20 equal installments or repayments, as I had told you earlier. How much is each installment? How much is each installment? So when you look at the period that we have, which is 20 months, actually 20 months is less than 2 years, because 2 years has 24 months. So it means she's not going to pay any interest on these repayments. We want to determine the amount in each installment. So each installment will be equal to the total amount, the total cost of the bed, divided by the number of installments. Number of installments to be made, and the total cost is $24.90, which is $2,490, divided by 20. This will give us that requires her to make an installment of $124.50 every month. This is the amount she will be required to part with every month. In fact, from this question, she might have bought this bed from a person that they have a good rapport. They understand each other well, because her being given an offer of buying the bed without an interest being charged over a given duration of time, it shows that they have some good relationship. So this is the amount she's supposed to part with at the end of every month. Let us look at another example, which will be example number 3. Let us look at another example, which will be example number 3. This example is going to elaborate on how interests accrue on the minimum account balance that an account holder can have. We are told a bank pays 0.3% interest a bank pays 0.3% interest on the minimum monthly balance in an account. In an account. Determine the interests due on accounts determine the interests due on accounts with the following minimum monthly balances. With the following minimum balances, monthly balances. The first one, we determine the interest due on $400. On $400. We are told the interest due, the interest that will accrue in the account is at the rate of 0.3% of the minimum balance. So the interest due will be 0.3% of the account balance. Of the account balance, and this will be 0.3 of $400, 0.3%. We want to find 0.3% of this. In other lessons, we have learned on how to find percentages of quantities and amounts, and we learned that for us to find a certain percentage of a given amount, we need to express that percentage as a fraction first or a decimal before we multiply with that amount. And I remember emphasizing that the best way for us to solve such questions is for us to express that percentage as a fraction. How do you express a given percentage as a fraction? We have learned that for us to express a percentage as a fraction, we write that percentage out of 100. So this will be 0.3 out of 100. That percentage out of 100. Then we multiply by the amount. And this will give us, zeros will cancel, 0.3 times 4, this will be $1.2. That is the amount that will be accrued in form of interest at the end of the month, given that the minimum bank balance is $400. Let us look at another one. B, how much will be the interest if the minimum account balance is $570? $570. This interest will be 0.3% of the bank balance, which is $570, and this will be 0.3 out of 100. We express it as a fraction and then we multiply by that amount. This will give us 1.71 $1.71. Next, part C, we calculate the interest on an account balance of $1,000. The interest is 0.3% of $1,000, and this will be 0.3 out of 100 multiplied by 1,000. These zeros will cancel out, and this will give us $3.0. This will give us $3. So at the end of the month, the interest that will accrue on the minimum account balance will be $3. And the total amount at the end of the month will be this minimum balance plus the interest accrued. That will be $1,003. That is what we have. So we have been looking at the interests that can be earned when one decides to invest in a bank. You invest your money in a bank, you let the bank use your money in carrying out its transactions or businesses. The bank can invest the same in other financial institutions or income generating activities, and at the end of the month or an agreed period of time, the bank will give the investor a certain percentage as interest. That is what we have been looking at. Having looked at that, I want us now to move on and look at repaying a loan, how loans are repaid. So our next subtopic is repaying a loan. How do we repay a loan? Loan repayments. For us to understand this loan repayments, we have looked at how repayments can be made every month and cumulatively at the end of a given period, be it a year, 2 years, 5 years, or 18 months, how much in total will have been repaid. So for us to understand this, let us look at it using an example. And our first example, is Wendy takes out a personal loan of $7,000. $7,000 to fund her trip to South Africa. to fund her trip to South Africa. Repayments are made monthly for 3 years. Repayments are made monthly for 3 years at $275 a month. $275 a month. We are tasked to find the total cost of Wendy's trip. The total cost of Wendy's trip. We need to be cautious when we are handling such a question, because when you look at it, she just borrowed $7,000. Is this $7,000 the total cost of her trip? No. The total cost of her trip will include the interests that will be accrued on this amount over a duration of 3 years. All the repayments that she will make towards that will be the total cost of her trip to South Africa. So we need to know how many installments is she going to make, because our total cost, the total cost will be the product of the number of installments and the amount in each installment. So how many installments are we talking about? If she is going to pay this every month over a period of 3 years, the number of installments will be 3 years multiplied by 12 months. For us to get the total number of months or installments in which this amount is going to be paid, and this should be multiplied by the amount in each installment, which is $275 per installment, and this will give us $9,900 shillings. This is the amount that she will pay in total, and that amount constitutes the total cost of her trip, because at the end of the 3 years she will have paid this towards the trip. The second question is, we find the interest charged on the loan. We find the interest charged on the loan. We find the interest charged on the loan. We find the interest that will be charged on that loan. And remember, the interest is usually equal to the total amount that was paid amount from our previous calculations minus the principal amount borrowed. How much did you went to borrow? She borrowed $7,000. How much did she pay back? She paid $9,990. So the difference between the two will give us the interest. This will be the difference between $9,900, subtract the principal amount borrowed, which was $7,000, and this will give us $2,900. That will give us $2,900. This can also be restructured and say of course that is the interest, but we can also say that the interest is equal to the total repaid total amount repaid minus amount borrowed. So the interest charged on $7,000 is $2,900 over a period of 3 years. Let us look at another example on loans repayment. Number 2, Alma borrows a person by the name Alma borrows $250,000 to buy a house. The repayments are $1,736 a month for 30 years. So we are told this person Alma just borrows $250,000 to buy a house, and the repayments are $1,736 a month for 30 years. A month for 30 years. The first question is, how many repayments does Alma make? How many repayments does Alma make? How many of them? We need to understand the number of repayments that will be made. If she is paying $1,736 every month in 30 years, and a year has 12 months, it means in 1 year, the person makes 12 repayments. How many repayments will be in 30 years? The number of repayments will be equal to 12 repayments made in a year multiplied by 30 years. And this will give us 360 repayments. This is the number of repayments that Alma will make. The next question is, what is the total amount Alma pays for the house? What is the total amount that Alma will pay for the house? I told you that when we are calculating repayments, it is good to distinguish between the amount borrowed that was used to buy the same house and the total amount that was paid to whoever the money was borrowed from. So the total cost of the house will be the total amount that will be repaid back. So the total amount that Alma will pay towards the house will be the number of repayments or installments multiplied by the amount in each installment. The amount in each installment. And this will be 360 installments multiplied by 1736, which is the amount in each installment. And this will be the total amount will be $624,960. And remember, the amount that was borrowed was just $250,000. But since the repayments are going to be made over a very long period of time, and based on the agreed interest within that period of 30 years, the total amount repaid is $624,960. The last question on this is, how much interest is paid over the 30 years? How much interest? How much interest is paid over the 30 years? How much interest? And just the way we've been calculating interest is the difference between the total repayments the difference between total repayments and the amount borrowed. The amount borrowed. And the total repayments are to the tune of $624,960, and the amount borrowed was $250,000. How much is the interest? The interest will be 374,960. This is the interest that will be accrued on $250,000 over a period of 30 years. Quite a long period. A long period. And you can also see the amount of interest that will have been accrued is colossal. I hope you have understood what we mean by investment and what we mean by loans. We started by saying that if you invest money in a financial institution or in an income generating activity, you will earn some interest. But if you borrow the same from a financial institution, you will have to repay it back with some interest. So interest is charged on you. Unlike in investment where you earn an interest, interest is charged on you. And we have also talked of repayments being the amount that is given back to a financial institutions in regular time intervals. And that amount includes the principal amount that was borrowed together with the interest. And we have looked at several calculations on how to calculate the interest. I now want to give you an assignment. Just 2 questions on loan repayments. The first question is, Jason has a personal loan of $10,000. He is repaying the loan over 5 years. He is repaying the loan over 5 years. The monthly repayment is $310. Part A is calculate the total amount Jason repays. Calculate the total amount Jason repays. The second question is how much interest is he charged? Once you have calculated the total amount that he will pay, you go ahead and calculate the interest, which will be the difference between the total amount repaid and the amount that was borrowed. That is question number 1. Let us look at a second question. Robert borrows $5,500 to buy a second-hand car. He pays the loan in 36 equal monthly installments. Six equal monthly installments of $155. Part A, you need to calculate the total cost of the loan. Calculate the total cost of the loan. And part B, you calculate how much interest does Robert pay? How much interest does Robert pay? This marks the end of our lesson. In our next lesson, we will be looking at how to pay off a purchase, paying off a purchase, and we can also look at calculating the interest. A very interesting lesson, and I hope you will be able to attend that lesson. Thank you and welcome.